ITV plc agreed to sell its media and entertainment division to Sky for approximately £1.6 billion, including an earnout of around £200 million tied to future M&E performance. The broadcast side, the free-to-air channels you switch on and the ITVX platform you stream from, is what Sky is buying. What ITV is keeping is its studios business, the production arm that makes and sells programs to Netflix, HBO, and broadcasters across 60 countries. That asymmetry is the tension. The market has long treated ITV as a declining broadcaster with a growing production upside. The deal resolves that internally by separating the two, but it does so at a price that reflects the broadcast half alone. The studios business, once separated, becomes an independent production company with no listed comparable in the UK and no deal multiple yet applied to it. The immediate pressure on any holder is straightforward. The £1.6 billion figure is not a full company valuation. It is a partial sale price for the declining segment. What the retained studios business is worth as a standalone, unencumbered by the broadcast drag that has suppressed the listed multiple, has not been answered by this deal. The deal accelerates the question. It does not settle it.
ITV Studios supplies content to global streaming platforms at a scale most UK investors have consistently underweighted. The production business distributes over 7,500 hours of original programming across 60 production labels. Its catalog exceeds 100,000 hours. Scripted deals with PBS Masterpiece, BritBox, Channel 5, Arte, and ZDF represent recurring revenue streams priced against international demand, not against the UK advertising market. The buried assumption in the consensus read of ITV is that the broadcast business is the company. Every analyst multiple applied to ITV since streaming disruption accelerated has been dragged down by the free-to-air advertising exposure. The studios business has never traded in isolation. Once it does, the drag is gone, and the reference class shifts from UK commercial broadcaster to international content producer, where deal multiples in the WBD Netflix transaction implied roughly £82 billion for the content and streamer combination. That does not mean studios commands anything near those figures. The relevant point is different. The £1.6 billion headline for the broadcast side implicitly assigns a residual value to the retained business, and that residual has not yet been confirmed by market pricing. The earnout structure, £200 million contingent on management and e-performance after the deal, signals that even the acquirer is uncertain about the broadcast side trajectory. An earnout on the declining segment is not confidence in its stability, it is a hedge written into the price. The tension reset. Most commentary treats the £1.6 billion as the ITV story. The sharper read is that the deal reveals the studio's value by exclusion, and the exclusion has not yet been re-rated.
The deal does not exist in isolation. Sky is being spun off from Comcast into an independent listed company alongside NBCUniversal in a transaction expected to complete in approximately 1 year. Comcast shares surged as much as 23% in pre-market trading on the announcement. Co-CEO Mike Kavanagh told analysts the company had changed our mind about whether broadband and media still belonged under one roof, an admission that the 15-year convergence thesis has been abandoned. The precedent for what happens next was written by Warner Bros. Discovery. WBD reorganized into 2 divisions, announced a tax-free split described as standalone strength, denied any deal intent, and within months had both Netflix and Paramount Skydance bidding. Netflix agreed an $82.7 billion deal. Paramount Skydance won at roughly $110 billion. Forbes, citing this arc, noted that the denial is not the data point, the script is. Applied to ITV, Sky, as part of the spun-off NBCUniversal entity, has agreed to acquire ITV's broadcast channels and ITVX weeks before the spin-off is complete. If the WBD template runs forward, NBCUniversal becomes a bid target. Its ownership of ITV's M&E division, a UK free-to-air and streaming asset, would sit inside whatever entity emerges from that process. That introduces a second-order acquirer risk into the ITV Studios rump. If NBCUniversal is consolidated again, the counterparty relationship for ITV Studios content output changes. 2 named sources in the pool draw opposing conclusions. Ross Bennis at eMarketer said NBCU will become M&A target eventually. Netflix would likely have interest in the studio. Mike Kavanagh said definitely not to deal preparation, then claimed freedom to pursue adjacent businesses. The conflict is in the pool, not invented.
The immediate verification anchor is CMA regulatory clearance for the Sky/ITV M&E acquisition. The Guardian reported the deal as weeks away from official announcement, meaning the formal notification has not yet been filed. UK broadcasting deals of this scale, combining Sky's pay TV reach with ITV's free-to-air footprint, carry material CMA review risk, particularly given the NBCUniversal Spinoff's simultaneous creation of a dominant news shareholding through ITV's 40% stake in ITN. If CMA clears the deal without structural remedies, the £1.6 billion price and earnout structure lock in, and the market can begin pricing the studio's rump in isolation. That is the entry condition for a holder or a watcher. Clearance removes the largest binary risk and triggers the re-rating question. If CMA requires structural remedies, particularly around ITN ownership, news plurality, or Sky/ITV combined market share in advertising, the deal consideration could be reduced or the earnout conditions revised. The £200 million earnout already signals contingency in the broadcast valuation. A remedy that adjusts the earnout baseline makes the implied studio's residual lower, not higher. The counter-evidence in the pool is real. Comcast has already written down Sky's value by almost a quarter since the 2018 acquisition and sold Sky Deutschland to RTL. The acquirer's track record with Sky as a European asset is not one of appreciation. That does not block the deal, but it sets the prior for how the new NBCUniversal entity, itself unpriced in a spinoff, might manage ITV's broadcast division post-close. The holder's monitoring variable is the CMA notification date and any early indication of the remedy scope. The watch listen candidates trigger is simpler. CMA clearance without significant structural conditions confirms the deal price and starts the clock on studios re-rating. Blocked or conditioned remedies make the current spread an overpay. The move is an entry if CMA clears and studios begins trading on independent content producer multiples. It is a trap if the broadcast earnout is revised down and the spin-off timeline extends into a global M&A auction for NBCUniversal that resets ITV's counterparty. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.